Welcome back, everybody. It's nice to return in the afternoon. Suddenly, the stage feels very far away from everyone. I hope if you have your headsets for translation, please put them on now. We'll try and speak in our best, clearest English on the panel this afternoon for those who don't want to use the headsets. I'm really pleased to be moderating this panel of what I'd consider to be some of the sort of heavyweights and maybe the kind of most adventurous pension funds around in Europe on the topic of responsible investment. And I was having some interesting discussions over lunch about how responsible investment is perceived in Switzerland. So I think I'm looking forward to some interesting questions and answers from you as an audience. So please, any of the most simple, complex, challenging questions that you have on the subject, don't hesitate. I'm going to get into a kind of a very, hopefully a rather brief 10 to 12 minute description of what each of our panelists does as a fund and what their main priorities on responsible investment are. Just as a very quick introduction to each of them before they introduce themselves. To my right, we have Daniel Ingram, who's head of responsible investment at the BT pension scheme, which I'm not sure if it's the largest UK pension scheme at the moment. It tends to joust with the university's superannuation scheme for being the biggest, but BT may, I think, be the biggest UK pension scheme. Great to have Daniel here, despite the fog in London, getting out this morning. Next to Daniel, we have Caroline Schum. I have to get the pronunciation right for the country. Caroline Schum, responsible for the Suisse Romande section at Nest Fondation, who will be known by many people here in Switzerland. An excellent example of a really progressive fund around responsible investment. Look forward to hearing from Caroline. To the far right, it's great to have Caroline, so I guess the Dutch version of Caroline in some ways, but Caroline van Lierop, who's the Director of Responsible Investment at MN. She'll tell us more about who MN is, but 120 billion in assets under management, so no small beast in the pensions world. We're going to start with Daniel, and I've asked Daniel to talk through just to give us a brief outline of the fund itself, his role within the fund, and to talk about how it looks at environmental, social, and governance issues. Daniel, over to you.
Thank you. Thank you very much. There's a real privilege to be here in this wonderful setting, and thank you very much for having me. Good introductions there from Hugh. A couple of things that stand out. One, talking about, perhaps, I can't speak for other panelists, but BT Pension Scheme being an adventurous pension fund. I wonder if I were to say that to my trustees, whether they would agree with that, because as we know, the term adventurous and
professionally
pension funds tend not to go that well together. I also wondered how long it would take for us to use the terms environmental, social, and corporate governance. And really, I think I just wanted to give you a little bit of reflection from my time at BT Pension Scheme, where I started in 2011, a little introduction on us as a 42 billion sterling pension scheme that actually closed to new members in 2000, in the mid-2000s. And we have 300,000 members, but clearly, I think similarly to a lot of other European schemes, as the scheme closed, we're beginning to de-risk, the pensioners are becoming more mature, and we are clearly changing the way we allocate our assets as a result. And all of this has implications for the way we think about responsible investment. And I think it's important to be clear there, where a lot of terms get bandied around: long-term investors, sustainable investors, environmental, social governance. And I really found when I came into this role that there was a lot of confusion around those terms, what factors we were talking about, what time frames, what sectors, what asset classes. And I felt that it was very important to try and build more of a discussion amongst our trustee board and amongst the senior executives within the pension fund. We're fully externally managed, so 100% of our 42 billion are managed by fund managers, both active and passive. So clearly, when you look at the stakeholders who are important for us to try to work with on this, the portfolio managers, the fund managers, are extremely important. So I decided to say, well, what we need to first start doing, let's take a first step and try and see what motivates us around responsible investment. If you're a proponent of the efficient market hypothesis, some of this will probably seem a little bit second order. If you believe that all of these environmental, social, and governance factors are already priced into assets and valuations effectively, and there's no mispricing as a result, you're probably going to discount a lot of these factors. If you're purely invested in perhaps more liquid, absolute return, shorter-term driven investment strategies, perhaps some of this is less material, less interesting for you. But at BT Pension Scheme, we have a long-term investment horizon. We're not long-term investors primarily. We have to deliver liquidity in order for the trustees to pay the members their payments on time. But we strongly felt that as a result of neglecting responsible investment, the trustees might be put into a difficult position whereby they might jeopardize their core mission, which is to seek investments with the optimal long-term risk-adjusted returns. And we looked at this idea of responsible investment, and we decided to pull together the academic and the practitioner evidence around this. The trustees, probably similar to a lot that you work with, felt that they wanted to see what was out there already rather than reinventing the wheel. And there's a huge, rich wealth of information and data that's already out there. We looked at the Harvard Business School study, which found that $1 invested in 1990 in a portfolio of sustainable companies delivered by 2010, $22. And you compare that to the $1 invested in 1990 in a portfolio of less sustainable companies that only delivered around about $15. And more we looked at a lot of these studies. And we didn't just look at these studies based on equity or passive equity. We looked at geography, so we looked at emerging markets. We looked at different asset classes. We're big investors in real estate, private equity, infrastructure. We wanted to look at the materiality of responsible investment to the risk-return drivers of those alternative asset classes, not just equity. And we also felt that it was important to look at time frames. So we pulled together all of this evidence, and we decided that this area has a very, very high burden of proof required. You know, that we almost apply an artificially high burden of proof to responsible investment relative to our other views around finance and investment, which I find hard coming from a pension fund where one of the biggest long-term risks that we face is around longevity, that we're still trying our best to understand the drivers around that and trying to predict longevity. But when we look at longevity, perhaps we should look at other longer-term risks the scheme faces, like climate change, like water scarcity, all of which have extremely urgent, the magnitude of some of these potential risks are extremely high for the scheme. So we decided that it was very important, Hugh, I know you want to come in, but we decided it was very important to think about long-term risk in the round and not just put environmental and social governance into a bucket, but rather treat this as a holistic approach to risk management. And that's very much where the trustees have settled on, that we see this as a holistic approach to risk management. Perhaps there's some upside, perhaps there's some alpha to be generated in some sectors and asset classes, but we very much were focused around the risk management side of things.
Okay, just maybe one step back, Daniel, for the benefit of this audience. What was the motivation for thinking about this term responsible investment? Were you under pressure from external bodies to do so, or was it a different way of you thinking about your role as a long-term institutional investor? What was the push really for the BT scheme?
Yeah, I think it's a great question, because I think there are, where you look at stakeholders for pension funds as a corporate defined benefit pension scheme, you look at BT PLC, the FTSE 100 listed company that's our sponsor. It's core to their growth strategy, delivering a sustainable business. They are investing very heavily in the future of UK telecoms infrastructure, and to do that, they feel that good environmental social governance practices can help to generate cash flows for the business in the long run. So we had alignment with our sponsor. That was very important, and we're seeing this more and more actually in the UK market. I'm less familiar with the Swiss corporates and how they relate to the pension funds, but in the UK market we're seeing Unilever, the pension fund, and the corporate, M&S similarly, and some of the banks as well. The more that the corporate is driving forward, for want of a better term, corporate social responsibility type of activities, it creates a sort of positive circularity whereby the employees, who are the future beneficiaries of the scheme, are the ones perhaps saying, okay, I understand what my employer's doing for me. Well, where's my, how's my asset, how are my pensions being saved for, what are they being invested in? So we're seeing a bit more of that come. So we think of it as sort of top-down drivers in terms of the sponsor. There's other top-down drivers in the UK which are regulatory. We've had a long raft of reviews and studies from the economist, Professor John Kay, his review of long-termism in the equity markets. We're seeing some of this come out of European Union directives in the IORP directive. And so some of this is top-down. And then we think of bottom-up in terms of our members, and in terms of also our agents, our fund managers, who are also, to give them some credit, in the past 5 years have been sort of, pushing the agenda further forward. Some of them have.
And talk, the one issue that I wanted you to talk about was, you mentioned earlier you're a fully outsourced scheme in terms of asset management. What does this concretely mean for the asset managers you hire? And can you talk a bit about some of the work you've been doing with other pension funds in the UK in stipulating what ESG integration means within the investment mandates that you give them?
Sure. Look, it hasn't been an easy conversation. When I first started the conversation with our fund managers in 2011, we got very confused very quickly. And more you find that fund managers are very keen to emphasize that they're already doing integration of environmental social governance in their valuations, for example, or in their post-investment monitoring of assets. But when you sort of look more into the detail and you do your due diligence on managers, you find that they're not particularly good at articulating what they're doing as part of the investment process. And it's our belief that we will pick better performing investment managers who have a robust process for integrating environmental, social and corporate governance, as well as stewardship activities in their investment process. So we found that depending on the core products of an investment manager, there does tend to be a difference in some of the fund managers, perhaps with more passive products, who focus more on what we call in the UK stewardship activities, and perhaps those with more active products that have
Just
focused.
for the benefit of those who don't know what stewardship activities would be, they would typically be...
So we define stewardship activities as effectively using, exercising ownership rights to hold management to account for delivering the long-term strategy of the business.
So voting your shares and engaging around the ownership of those shares.
Proxy voting's one part of things, but we tend to see it more of a sort of a dialogue behind the scenes in order to enact change, both to enhance value, but also try and avoid the destruction of value at some of these businesses. So, distinction between different portfolio managers and the products they offer. I think what we were pretty aware of about a year ago was the fact that we were getting to a point where we were finding a group of quite strong portfolio managers in this area, and then a very long tail of others. And we felt that often portfolio managers say, oh, isn't this about, excluding, tobacco companies or excluding armament companies. And we don't apply any negative exclusion screens. We do some innovative tilting in our passive portfolio, tilting away from high carbon businesses, for example. And we also do a lot of work around the engagement side of things. But managers just were getting very confused. And I said quite often the role of managers is to deliver performance and products that clients desire. So they're quite good at saying, okay, well, we've got a new SRI fund, but on the whole, the large institutional investors don't have an allocation to SRI funds because we take more of an integrated approach to this. So within this integrated approach, they said, well, it's already integrated, it's in there, it's in the process, I'm already doing this, what more do you want? And I said, well, look, for now, we need to give you a much clearer idea of our expectations, particularly around reporting. And we want to see more reporting around responsible investment within the performance and risk reporting that our managers supply to us, in order to help us not only hold managers to account for delivering their mandate, but help us to understand the materiality of environmental social governance on the risk-return drivers of that particular mandate.
Okay, and that was done with a group of, if I recall, about 6 or 7 big pension funds in the UK, both corporate and local authority schemes?
Actually, it was about 15
okay.
UK pension funds, around about, I think, over 200 billion sterling of assets, collaborating to say, look, we're a very large pool of capital. We're relatively aligned that we would like our managers to improve on their responsible investment reporting, particularly in public equity I'm talking about. And so we put it out there, this report, which I'm happy to share. And managers have come back extremely positively to say, this is so helpful for us to understand what your expectations are. You're the client, you're the demand side of the chain. And it's really helped to move things along. So happily share it round, and it's been a positive step.
Great. Let's come back to that later on. Caroline, I'm going to have to be careful on my pronunciations here. Caroline, I think I'll try a slight Dutch accent on that one. Talk to us about MN. Give us some background, a quick background to the fund itself, or the multiple aspects of the fund, and then if you could talk to us about the practicality of why and what you do around environmental, social and governance issues as a big investor.
Yeah, sure. Thank you very much for the invitation. It's great to be here. I thought I might start very brief in French, but I think I just stick it to English.
Could you just hold the mic a little closer? I think.
Yeah, okay.
You have to be kind of. Yeah.
Merci beaucoup pour l'invitation. C'est merveilleux d'être ici. Je pense que c'est mieux que je parle en anglais. Indeed, I will tell a little bit about what we do as a man, why we are working on responsible investment, and even maybe more interesting, how we do that. I'm heading our responsible investment department. I'm working for MN. MN is a fiduciary manager and asset manager in the Netherlands. We manage indeed 120 billion. So our large clients are pension funds in the Netherlands in the metals industry. We have 2 really large clients representing 100 billion, and we have a bunch of pool clients in apparel industry and in shipping industry. I think sort of the origin of where we started with our responsible investment policy was very much sort of originated from exclusion, and I think there was a specific documentary broadcasted in 2008 on cluster munition in the Netherlands, and in that broadcasting there were very specific conclusions about many pension funds in the Netherlands that do invest in listed companies that produce cluster munition. I think there was a shock in the Netherlands at the time, and that was for many pension funds sort of a turning point, and say, okay, we're now under scrutiny, there's a lot of media attention, a lot of political attention, and that I think was the origin for many pension funds in the Netherlands to start with a policy, and that also was the start of coming up with an exclusion policy at MN. But yeah, over time there was so much added to that, because we started with exclusion, and now you see there's, I think, over the last 3 years, we did a lot in terms of negative screening. And I think sort of the new trends that you see are very much working towards positive screening and even positive impact. Maybe that's a bit far-fetched, but I think this is really the stage that we are in the Netherlands, looking at not only what are the negative consequences of the investments, what we do, the negative impact, but what is it that we can do to really create positive value in society. And maybe to be really clear, the first priority of our pension funds, of our clients, is really to make good returns and to take care of the pension funds of our beneficiaries. So, and we really think that the mandates that we get from our clients really give us the opportunity and the room to do this within those mandates and still to make good returns. So why do we do this? I think, as I just maybe briefly explained, it sort of started with reputational risk, and maybe that is typical for the Netherlands. There's a lot of media attention, a lot of NGOs, a lot of trade unions. The trade unions are represented also in the boards of the pension funds. So this really is a hot topic, and there's a lot of debate about it. So there's really no option to do nothing. But then between the different pension funds and asset managers, there's quite some difference in how ambitious you would want to be. There is peer pressure, although our clients always say we do not feel the pressure from an APG or a PGGM, but obviously they do look at what they do and how they go about it, and I think maybe it's not pressure, maybe you could say they get inspired, but I think the different pension funds in the Netherlands very much compare themselves and see how they perform against the peers in the market. But we also think, and our pension funds really think, that ESG is material. And maybe we do not have enough time to really go into details, but I think Shell and some of the downridings that we've seen last week, some developments in terms of stranded assets, stopping with their operations in Alaska, but also what we've seen recently in terms of Volkswagen. I think these are the kind of material examples that we're very much focusing on, and with the work that we do in terms of engagement, because that's also one of the sort of pillars that we have in our program. We do talk to those companies, and we try to address the ESG concerns that we see. So we really, try to have a conversation with Shell about CapEx and how do you make sure that you're going to be prepared with climate change, and how are you going to have a long-term view and a long-term strategy. So I think these kinds of examples really point out that ESG is material, and you cannot sort of deny the environmental, social, and governance factors out there. Long-term horizon, I think it's almost sort of naturally that as a pension fund looking after the pensions of the beneficiaries, which is almost sort of a long-term activity in itself, and it's very much about looking at future generations, it's almost natural to also sort of incorporate that in the way you want to invest. So I think the whole sort of new debate about long-term mandates, buy and hold, this is something that our clients are very enthusiastic about, and we're coming up now with some new equities portfolios very much focusing on this buy and hold principle. I think you could say maybe it's very natural as a pension fund to invest according to such a long-term horizon.
Caroline, is that part of a rethinking of how you operate as a long-term investor and as a pension fund? Has there been a shift there amongst the big Dutch pension schemes? It sounds a little bit like almost following the kind of Canadian model, at least thinking about liquidity, thinking about the fact that you have long-term horizons, and then almost reshaping the investment world a bit to fit your own view of the world. Is that a fair description? And how is that translating into those discussions you just mentioned?
Yeah, I think it is a fair description. We're now in the middle of a sort of a review of our responsible investment policy of one of our key clients. And one of the debates that we're now having, and it's really interesting to have such a exchange of thoughts with the board members, we just really ask them, what kind of equities investor do you want to be? Do you want to be passive and follow an index, or do you believe in value creation? And do you think that if you have maybe like a concentrated portfolio or a portfolio more based on positive screening, like this one, do you think that in the end you will be able to pick the companies that will stay in the long term, will be like sound, solid investments for future? And I think what we see in the boards of our pension funds, that this is sort of a belief that is getting more and more support. Yeah. So and I mean, let's be honest. That's not going to mean that overnight we're going to lose passive index investment. I think our first clients are getting some experience and now starting up pilots with more small scale portfolios, concentrated ESG tilted portfolios. But I think when performance will indeed be good, there will be probably more clients that will join, and we will scale up. So, and there's maybe one point to add. There's in the Netherlands, there's sort of an exchange of our CIOs of the 15 largest asset managers, and I'm also part of this sort of exchange. And 3 days ago, in a financial a newspaper that we have in the Netherlands, they published an article about that all those CIOs very much believe in long-term investments. So I really think this is sort of a trend, at least in the Netherlands, maybe indeed sort of following Canada.
Okay, and how much of the assets at MN is managed internally, how much externally?
It's a little bit more than half that we do internally, yeah.
Okay, so 50, sort of just over 50-50. Okay, internal, external. Okay, let's go on to Caroline. We'll come back to some of those points. Great, some really interesting stuff raised. In the interests of making sure we give everyone a fair slot, Caroline, you're representing the home team to some extent as the Swiss fund on this panel. I'm sure some people will know Nest, others might not be so familiar. So talk us through Nest and then give us a flavor of how you think of responsible investment and why you think of it and what it brings to you as a fund.
Okay, so I'll try to explain a little bit about what is Nest. First of all, sorry for my English. I don't speak so great like my other panelists. I think the aim that why I'm on the panels, it was a little bit to show that it's also possible in Switzerland to manage assets from a pension funds with responsible investments. The story is Nest is quite different of what I heard. Responsible investment is really belongs to our DNA. It was one of the reasons of the creation of Nest. Nest was created in 1983, so when the law on pension funds was voted, the LPP, because small entrepreneurs didn't want their savings being managed by bigger insurance companies and banks. And it was also smaller entrepreneurs who also had, at that time, we weren't talking about sustainable development, apart in the smaller specialized field. And they had some very simple criteria at the beginning. They didn't want nuclear energy, no weapons, respect for environment, and respect for human rights. That was all. And the beginnings were very difficult because we are in Switzerland, and the Swiss government was a little bit regarding the pioneer of Nest a little bit not very good. Nest worked almost during 10 years without validation of its Foundation Act. They're always saying, no, we don't know what you do, and the beginning was very difficult.
That was from the government. They weren't
from
too,
the government, yes,
okay.
from the
They weren't
from
too sure what you were. Okay.
And in the 90s, there was a scandal in Switzerland where we discovered that some citizens in Switzerland were in the fish, were listed, and some information on them. And we discovered that all the founders of Nest were listed in these fish. And shortly after that, the Act of Foundation was adopted.
For the benefit of English speakers, fish is not a poisson, but it's a list of people's names on a sheet.
Thank you.
That's okay.
And so that just to say that sometimes to be a pioneer is not very easy, but that doesn't mean that we are not successful today, and that's what I would like to tell now. Now we are not anymore a small pension funds. We manage almost 2 billion. So in the paysage, in the landscape of Switzerland of pension funds, it's not small pension funds anymore. We are a fondation collective foundation. I don't know how you say that. We work for 3,000 companies. That means that 3,000 organizations that are insurance at Nest. It can be smaller companies, bigger companies. We have maybe 20 companies with over 100 employees. In total, there are 20,000 insurance people all over Switzerland. At Nest, 10% in the French-speaking part. It's growing. How
much growth in the number of members of Nest have you seen in recent years?
We have between 10 and 15% growth.
Okay, in the
yes.
number of companies that sign up
yes,
to Nest.
Yes,
Okay.
in terms of assets, in terms of companies, in terms of yes, and there are two reasons for that. So the people we regularly do some survey about our clients, why they join us, and we know that the majority of people join us for the values. But not only, we know that 70% when we make the survey, 70% of the companies join us for the values, but also there are, that's the other thing which is important, that we have to be in the market with price, with performance and everything, otherwise it doesn't work. And 30% of our clients just come for other reasons, because we are sometimes cheaper, sometimes we have more flexibility, sometimes for our service and so on. And we found that, yes, it's quite interesting to see that also.
So let's just talk about some specifics there, Caroline. How do you invest as a result of your policy, and what is the strategy of investment? So you have certain areas that you exclude, but how do you then invest? You're predominantly invested in equities or in bonds or across all asset classes. How does that work? Just for those who don't know.
So the pension funds are very regulated in Switzerland. Yeah. So our asset allocation is very classical. Mm-hmm. We have 70% of equities, 25% of bonds, 25% of buildings, and some private equity. It's very classical. Okay. So what we do when we have a little bit developed over the years, develop our exclusionary criteria. So that's for me rather what I would call ethical reasons. That's really what we don't want to see in our portfolio, like weapons, tobacco, and so on and so on. And then we give to an external analysis company which have positive criteria to select that, and it defines the investment universe. Mm-hmm. And we have made some analysis nowadays about this universe. We know that after the exclusionary criteria and the positive selection, the asset manager only has 1/3 of the MSCI world, for example. So we exclude 2/3 of the MSCI world, which we consider is not investable in the terms of Nest. also we had great performance those last days, so we outperformed. It's not an objective to outperform the market, but only for us it's important to be in line with the market. So, but even though we outperformed the Credit Suisse pension fund index the last 10 years in a mean value.
Okay, so you've outperformed. I don't know the Credit Suisse pension fund index. I'm sure people here do know it very well, but you've outperformed that index. I mean, I'm sure it has credibility amongst pension funds, but your performance has been good for a number of years now, hasn't it? Real performance as well.
Yes, over the last 10 years, the performance was 4.7% per year, and the index had 3.9% per year. Yes.
Yeah. See, that's interesting because most people in the investment world would say if you exclude 2/3 of the MSCI world, then you've removed a vast amount of the efficient frontier of investment and you can't really perform. You know, so it's an interesting, maybe there's perhaps an element of luck there, but do you think it's more as a result of the responsible investment strategy, or?
So I'm not myself an asset manager, but when I ask our responsible person inside Nest for the asset management, he doesn't say we don't know, but he always says it doesn't bring anything, it doesn't cost anything, because often it depends what he observes. We never studied that systematically. What he observes sometimes, some years ago, it was interesting again to invest in nuclear energy, for example, and then, so we had because of that, rather bad performance, and then you had Fukushima. So then again, you have better performance, and he said the same, we don't have any oil company, for example. Some years it's better, do not have oil company, sometimes, so it's always reversible. What it says, what is most important, you also mentioned that, Daniel, it's to have a strong process, to follow the process, to have a strong strategy, and then a good selection of the asset manager.
Okay, and Caroline, you mentioned to me that you'd carried out a client survey as well. Go on, please.
One thing more, maybe, what could also explain the better performance is with the selection we have with sustainable development in our criteria, we have a tendency to exclude the bigger companies like UBS, Credit Suisse, Nestlé. And over the last year, small and medium-sized companies have sometimes better performed.
So
also, that could be another
from a
side
and
effect.
Mid-cap bias. Okay, and you did a client survey recently just to see what the response was like from companies around this mixed values and value approach. Talk about that. So the people who are the member companies, what are they looking for in a pensions provider? A lot of people in this audience will be interested to know what that might mean.
You mean what their motivation to come to Nest?
Their motivations to come.
Okay.
Yeah, I mean.
So it's quite diverse, I would say. There are, as I mentioned, I would say more than half of the 60-70% of the small and mid-sized company who come to Nest come first. They heard about Nest because of the values. But for sure, it has to also have to bring some performance too, and usually they are quite surprised that the price is good, the performance is good, so they are almost more motivated to come, because sometimes they just come to see what we do. Eventually, could we change to your pension funds? They are sometimes quite skeptical, and in the survey, almost all people who responded to the survey said we had a good, how to say that in English, rapport qualité-prix.
Okay, yeah.
Yes.
Good price, good value. Your good value in terms of quality of price and the services that you provide.
And we also ask, because it's always a challenge for Nest there is a tension between doing more sustainability, taking more risk. There is always a tension between, we could do more sustainability. I was yesterday evening on a panel, it was about disinvesting in fossil oil. So the people were thinking we are not doing enough. Maybe today you think we are doing too much. But it's always a tension what we can do more without taking too much risk. And we were also asking if some people would agree to renounce to some performance and that we do more sustainable investments. And 55% said no, it's fine like you do. And 45 people would agree to add more, but I don't believe in those 45% actually, personally. I think we also always see if financially it works at Nest, we begin to get criticized on our sustainability, and if the financial side is not great, then people forget the sustainability actually. But
okay, I would be fascinated to see who the entrepreneurs are that lead their companies to Nest. It'd be interesting to meet them, I think. Just thanks to our excellent panelists for their interventions. If we could show our appreciation in the usual way. Thanks very much, and thank you.